It's official. As of December 1st, 2025, the Federal Reserve has called time on its quantitative tightening program. This puts an end to a roughly 3-year experiment that has cast a long shadow over everything from your 401k to the rate on your mortgage. Now, this wasn't a surprise. The Fed has been telegraphing this move for months, but the implications are still huge. For the first time since June of 2022, the central bank is no longer actively, systematically, and relentlessly pulling money out of the financial system. This is one of the biggest market pivots of the year. The Fed is shifting gears from active tightening to a neutral stance, and that changes the entire game for investors. A major headwind that has been pushing down on asset prices has just disappeared. So what does this massive shift mean for your money? We're going to break down what the end of QT means for stocks, bonds, crypto, and the US dollar. And more importantly, where the smart money might be heading next. Because while everyone is waiting for the Fed to cut rates, it may have already made its most important move. Before we get into what this all means, let's do a quick, simple refresh on what we're even talking about. You hear QE and QT thrown around all the time, but what do they actually do? First up was quantitative easing, or QE. The easiest way to think about QE is the Fed slamming its foot on the economy's gas pedal. During the pandemic, when the world shut down, the Fed printed digital money to buy trillions of dollars worth of government bonds and mortgage-backed securities to keep the financial system from collapsing. This flooded the banking system with cash. When the Fed buys bonds, it makes it cheaper for banks to lend and businesses to borrow, which gets people spending and pushes investors toward riskier assets like stocks. That's how the Fed's balance sheet, basically a list of all the assets it owns, swelled to an incredible $9 trillion. But all that money printing had a side effect we all felt: runaway inflation. To kill that inflation, the Fed had to pull a complete 180. It started hiking interest rates and kicked off quantitative tightening, or QT. If QE is the gas, QT is the brake. It's the exact reverse. Instead of buying bonds, the Fed just let its existing bonds roll off its balance sheet as they expired, without reinvesting the money. For instance, if a $1 billion Treasury bond matured, the Fed would let it expire. The US Treasury would pay the Fed back, and that cash would then be removed from the banking system, reducing the reserves banks have on hand. This process systematically pulled money out of the economy. Starting in June 2022, the Fed's QT program aimed to drain up to $95 billion a month from the system at its peak. The goal was to soak up the excess cash that was fueling inflation, and the scale was massive. Over the course of about 3 years, the QT program shrunk the Fed's balance sheet by roughly $2.4 trillion. The mountain of money the Fed created was being steadily chipped away. This constant liquidity drain acted like a gravitational pull on the markets, making money more expensive and weighing on asset prices. So why stop? The simple answer: the engine started sputtering. The Fed was draining liquidity to fight inflation, but it got to a point where it risked breaking the financial system's plumbing. By late 2025, some warning lights were flashing. Bank reserves, the cash that banks hold at the Fed, were falling to levels that made officials nervous. The overnight funding markets, where banks lend to each other, started showing signs of stress. Basically, cash was getting so tight that the system was struggling to operate smoothly. Many feared a repeat of the 2019 repo market turmoil, when a similar cash crunch caused lending rates to spike, forcing the Fed into an emergency intervention. Seeing similar risks on the horizon, the Fed decided to stop draining liquidity before something broke. It wasn't a declaration of victory over inflation, it was an act of prevention. So on December 1st, 2025, the program officially ended. After shrinking by $2.4 trillion, the Fed's balance sheet stabilized at around $6.5 trillion. In practice, this means that when the Fed's bonds mature now, it will take the money and reinvest it into new bonds, keeping its total holdings steady. The great liquidity drain is over. But here's the most important thing to understand. Ending QT is not the same as starting QE again. Think of it like this. For the last 3 years, the Fed has been driving with its foot firmly on the brake. Now it has taken its foot off the brake. The car is no longer actively slowing down. But the Fed has not moved its foot over to the gas. It isn't pumping new money into the system. It has just stopped taking money out. This is a shift from an actively restrictive policy to a neutral one. The headwind is gone, but it hasn't been replaced by a tailwind yet. This little detail is the key to understanding what happens next with your portfolio. We are in a new phase, a period of stabilization, and it changes the math for every asset class out there. So what does this mean for the stock market? For stocks, taking away the headwind of QT is a big deal. For years, QT has been like gravity, constantly pulling on stock prices. Every month, billions of dollars were being vacuumed out of the system, leaving less capital available for risk assets like stocks. Now, that force has been switched off. The connection between central bank liquidity and stock market performance is one of the most watched relationships in finance. Generally, when liquidity is growing, stocks tend to do well. When it's shrinking, they face pressure. The end of QT stops the shrinking. This gives the market a much more stable foundation to build on. History gives us some clues here. When the Fed paused its last QT cycle back in 2019, the stock market went on a strong rally. Many analysts are now looking at that period as a possible roadmap for 2026. With the foot off the brake, the market has more room to accelerate, especially with rate cuts also expected on the horizon. This could be especially true for certain types of stocks. More stable long-term interest rates tend to help growth sectors like tech and AI. It could also give a lift to areas that have been beaten down by high rates, like small cap stocks and real estate. But let's keep a level head. This doesn't guarantee a one-way trip to the moon for stocks. There are still real risks out there. For one, stock valuations in some areas are already pretty high, and the 2025 rally was led by just a handful of giant tech stocks. For the market to have a truly healthy run, we need to see more stocks participating in the gains. Finally, the real economy still matters. Some might see the Fed stopping QT and planning rate cuts as a sign that it's worried about a potential recession. So while the technical picture for the market has definitely improved, investors are still weighing that against the risk of a weakening economy. The removal of QT is a powerful positive, but it doesn't just erase every other risk. If you're getting value from this breakdown and want to stay ahead of the curve, do me a favor and hit that subscribe button. We put out deep dives like this all the time to help you make sense of these huge market shifts. Next up, bonds. The impact here is even more direct. During QT, the Fed was a huge, predictable source of supply pressure on the government bond market. By letting up to $60 billion in Treasury bonds mature every month without buying new ones, the Fed forced private investors, people like you, pension funds, foreign governments, to soak up way more government debt. And when supply goes up, prices tend to go down. For bonds, falling prices mean rising yields. QT was a constant source of upward pressure on bond yields. Now, that pressure is gone. The Fed is back to being a neutral player, reinvesting its money instead of stepping away. This fundamental shift is expected to let bond yields stabilize or even drift lower. In early December 2025, the 10-year Treasury yield was sitting around 4.09%. And with QT over, many analysts think yields have peaked for now. What's that mean for you? First, if you own bonds, this is good news. As yields fall, the price of your existing bonds goes up. Second, lower government bond yields ripple across the whole economy. It could mean lower mortgage rates, cheaper business loans, and a smaller interest bill for the US government itself. Plus, the end of QT should help the bond market just work better. The constant pressure of QT was causing some creaks and groans in the system. By pausing the runoff, the Fed is helping ensure things run smoothly, reducing the risk of those financial plumbing problems people were worried about. In short, the bond market can finally take a breather. The era of the Fed actively pushing yields higher is over, setting up a much friendlier environment for bond investors in 2026. Now for the wild side, cryptocurrency. For assets like Bitcoin and the altcoin market, the end of QT is a huge macro shift. More than almost any other asset, crypto runs on liquidity and risk-on sentiment. The whole point of QT was to kill both of those things, which made it a brutal headwind for the crypto world since 2022. A shrinking money supply and rising borrowing costs made speculative bets a lot less appealing. Money flowed out of high-risk assets and crypto took it on the chin. The end of QT flips that script. It stops the liquidity drain that was holding the market down. Historically, crypto has done incredibly well during times of easy money and plentiful liquidity. And while this isn't a return to full-blown QE, a Fed that is no longer tightening is a major positive. It creates a much better environment for money to flow back into riskier assets. The historical parallel is interesting. Back in 2019, when the Fed paused its previous QT program, Bitcoin went on a tear, surging from around $3,200 to over $13,000 in about 6 months. Now, other factors were certainly at play, but many analysts are pointing to that period, suggesting a similar narrative could unfold in 2026. So what are the effects? First, it should help stabilize prices and cut down on some of the macro-driven volatility. Second, when you pair this with expected rate cuts, it makes holding assets that don't pay a yield, like Bitcoin, more attractive compared to bonds. The thinking is, if money gets cheaper and liquidity stops disappearing, you have a potent recipe for a recovery in crypto. This liquidity relief comes as the crypto market itself is maturing, with more institutions involved. The end of QT removes a major barrier and could be the catalyst that renews interest and sets the stage for a new cycle of growth in 2026. Finally, what about the US dollar? For the last few years, the Fed's aggressive tightening was like a magnet for the dollar. Higher interest rates and a shrinking money supply made holding US dollars more attractive than other currencies. QT was a key pillar supporting the dollar's strength. With QT over, that pillar has been kicked out. When you stop shrinking the balance sheet and start planning to cut interest rates, the appeal of holding dollars starts to fade, especially if other central banks aren't easing as quickly. Think of it like a vacuum cleaner. QT was sucking dollars out of the global system, creating scarcity and driving up the dollar's price. That vacuum has now been switched off. The Fed isn't spraying money back out with a fire hose, that would be QE, but the draining has stopped. The most likely result is a gradual softening of the US dollar. We're not talking about a collapse, but a gentle drift downward as one of its key supports is removed. A weaker dollar is often a good thing for US companies that sell products overseas, and it can be a relief for emerging markets that have a lot of dollar-denominated debt. For currency traders, the takeaway is that the policy winds that were blowing in the dollar's favor have now shifted to neutral. So to wrap it all up, the end of quantitative tightening is a huge pivot. The Fed has officially shifted from actively tightening to standing on the sidelines. For the stock market, a big headwind is gone, which could clear the runway for a broader rally, even if economic risks are still out there. For the bond market, the absence of a massive supply pressure means yields will likely stabilize or fall, boosting bond prices. For crypto, stopping the liquidity drain is a major bullish catalyst that has historically been linked to strong performance. And for the US dollar, a key source of its strength has vanished, pointing toward a gradual softening. This brings us to the big, forward-looking question. This isn't QE yet, but is that where we're heading? The short answer is, eventually, that's the debate. By stopping QT and signaling rate cuts, the Fed has taken a clear step away from tightening. The next phase in the cycle is always easing. While another massive QE program isn't on the table for tomorrow, the market's focus now shifts entirely to when the Fed will start cutting rates and what it would take to get them to turn the money printer back on again. To make sure you don't miss our analysis on that, be sure to subscribe and hit the bell for notifications. You'll be the first to know. And finally, I want to hear from you. What are your biggest questions about the end of QT? Do you think this is the start of a new bull market? Drop your thoughts in the comments below.